So let's kick off. So most of you, I think just about everyone knows me. I don't know if there's maybe a couple of folks that aren't on camera that I'm not seeing anyway, that maybe haven't, but my name is Ismael Reyes and I'm here out of Orlando. And I just want to welcome you to this edition of the Greater Central Florida Multifamily Investors Group virtual meeting. So this group is about folks that are in the area that want to invest in the area, and folks in the area that may want to be investing other places, but you want some local folks that you can kind of bounce ideas off. So it's not just about Central Florida, but that is a big piece of what we're doing and looking at. So as I mentioned before, we'll just have some quick intros for whoever has not had a chance to be on this call before. We'll see. I think everyone, just about as far as I can tell. But if somebody's new, this is your opportunity, about a minute, to just kind of talk a little bit about what, where you're from and what you're trying to do, and go from there. So I'll open up.
Yeah, I'll start here. My name is Joey, and I'm from Minneapolis, Minnesota, and I am looking to do some ground up multifamily. I've got a partner who's done quite a bit of it in Minneapolis. I'm trying to convince him, hey, I think we got to take a look at Florida and Texas. I think we're getting a little hyper supply here, so we're checking out the markets and trying to meet people and connect. So, and kind of hear from the experts, the locals. So.
Awesome. And Joey, I know we know each other, but I hadn't realized this was your first time on the call. So thanks for chiming in.
All good, buddy. No worries.
Anybody else?
Yeah, I'll go.
Okay.
Chris Troutner. I'm based in Maryland. I actually flip houses in Pinellas County, Florida, and I've been involved in multifamily for the last couple of years as a key principal and a limited partner in Houston and Pittsburgh. But I like Central Florida, so I'd like to find a multifamily in that area. I've had a mobile home under contract, but that ended up falling through in Lakeland.
All right. Nice, Chris. Yeah, Lakeland is kind of like sweet spot between Orlando and Tampa, so it gets a lot of play because you can kind of go either way there. Good. Thanks, Chris. Thanks for chiming in and for joining us.
Sure.
Who else we got? Anybody else? First timer?
Hi, my name is Tamara Brown. Can you hear me?
Yes. Hi, Tamara.
Great. Hi. So I'm from Philadelphia, Pennsylvania, and I've been in multifamily for maybe about a year and a half. And so I've been looking at Texas, and I also wanted to look in Florida as well.
Nice.
So
those are the Texas is hot market. I mean,
yes,
both those markets. Well, certainly anything south, I think, is doing, at least over the long term, doing pretty well. And so we'll leave the analysis today to Carl as he kicks off here later. But thanks for joining us, Tamara. Appreciate it.
All right. Thank you.
All right. I think anybody else? I think everyone else is, at least so far, the ones that have popped in. Hopefully we get some more people coming in here. But if not, what I'd like to do next, for those of you that were here on time, we're just going to do a quick happy snap here. A Zoom selfie. So I'll give you a minute while we get set up here to put on your best face. I really can't do much with mine, but it is what it is. All right, 3, 2, 1. Happy holidays. I guess at this point, I think I'm just gonna do your intro, Carl. And for those that don't know, I think most people were already in, but Carl is actually joining us from his vacation. And so, Carl, I really appreciate it down in Key West. And I appreciate you taking the time. So let me a little bit about Carl here. Carl is the manager of market analytics for RealPage. And he blends his passions for geography and teaching to foster a practical applied understanding of apartment data and analysis. He specializes in creating in-depth reports and presentations to allow for easier consumption and application of data and analysis. Prior to joining RealPage, Carl was a market analyst for Axiometrics and an analyst for Catalyst Commercial, a Dallas-based economic development solutions firm. Carl received a bachelor's degree in secondary education and a master's degree in applied geography from the University of North Texas. So Carl, I'm going to just turn it over for you, man, to you. And thanks for being here. We're looking forward to to seeing what you and the team there at RealPage is seeing. I got to tell you, I look at your reporting all the time, and it's just one of the best places, one of the places we can really kind of dig in and get some good info.
Yeah, absolutely. Well, and thanks for the kind intro there, Ray. Really do appreciate it. I pulled up a screen share here. Should say national overview. Just want to make sure everybody can see the screen share. Everybody good? Seeing some thumbs up? Okay, perfect. Well, let me see if I can minimize real quickly. There we go. See if I can minimize some of those screen controls. Well, as Ray said, my name is Carl Whitaker. I lead up our team of market analysts here at RealPage under the chief economist, who's doing a little bit more of the national broadcasting, if you will. And what I've kind of planned for today is 30, 40 minutes to really recap at a very high level some national stats that we're seeing. And then as we move through the presentation, we'll really focus on some of the Florida markets, maybe most importantly, including some stats on the forecasts that we have for these markets, because that's probably the most important question. You know, you're not putting your money in what happened 10 years ago, you're putting your money in what's happening today and then over the next 5, 10 or so years. So that's the flow of today's presentation. With obviously, this is a very informal group, so feel free to interrupt with any questions at any point. We certainly welcome those. Having said all that, again, just wanted to start with this national overview. And what's been really interesting thus far is that through the whole coronavirus recession or the COVID-driven recession, is that apartments have been doing pretty well relative to some other property sectors. Now, when we look at the economy in particular, we're seeing that different economic sectors are recovering at very different paces. Nationally, in the most recent stats that we had, looking at November 2020 job losses over the past year, the U.S. has lost about 9 million jobs, or about 6% of the economy. But when you start breaking out components of that job loss, again, you'll see that it's very different across these sectors. When you look at these higher paying sectors, including information or your technology jobs, financial activities, which is going to, of course, be your banking type jobs, and then professional and business services is kind of that catch-all for your white-collar office employment, if you will. There haven't been that many job losses. And, you know, I hesitate to say there haven't been that many. I don't want to diminish the impact of 1.4 million jobs lost, but relative to the national average, that isn't the majority of what jobs have been lost thus far. And you can say the same thing for your bread and butter blue collar employment, construction, manufacturing, government, healthcare services, teaching jobs. Again, the economic losses haven't been skewed towards these parts of the economy. What we're really seeing is that it's these lower paying service sector, retail, restaurants, tourism jobs that have really been feeling the brunt of the economic downturn. Now, this probably isn't necessarily groundbreaking information for anybody on the call, but I do want to point this out because this does color some of the Florida markets in particular. I think this does help set the stage for what's going on locally, in addition to how the economic recovery will take shape over the next 2, 3, 4 years. Now, looking at some of these national stats again, what we were honestly, just candidly speaking, a little bit surprised about in third quarter was that demand was exceptional. This is looking at the number of units absorbed in third quarter alone across the nation. And you can see that about 160,000 units were absorbed in third quarter 2020. And that's the best third quarter we've had in the past decade. I mean, I think that surprised a lot of people, and again, ourselves included. So that's a really good number. That tells you that, again, there's just solid demand out there for apartments. And this isn't an anomalous number. It's not like 160 is somewhere completely out of the blue. If you compare that to the past few years, this tells you there's a lot of people out there who are renting apartments, moving in. I don't see this going away anytime soon. I'll talk about our forecast here in a second, but overall, that's a very good number that we were encouraged by. When we look at our national occupancy, you can see that as of November, occupancy is still above 95.5%. If somebody would have told you back in 2008 and 2009 that 10, 11, 12 years from now, you were going to be sitting at 95.5% occupancy during a recession, somebody would have probably escorted you out of the building. You know, nobody would have believed that. That's just incredible occupancy. We're down only 10 basis points year over year. Now, obviously, I'm looking at this through a little bit of a rose-tinted set of glasses, but this does show that apartment demand is really good. Now, when you start breaking apart components of apartment demand, that's where the numbers start to look a little bit different. And what's interesting is that your product type isn't necessarily reflective of the challenges in the economy. Based on what I showed earlier about the higher paying job sectors performing better, we're not necessarily seeing that on the performance side. And you can see here that Class A occupancy is lagging the other product types. It's down about 70 basis points year over year compared to B and C, which are holding relatively flat. And I think this points to a few things, but the first being lots of new supply coming online. And I think that's important in some of these Florida markets where you've really got a big run up over the next few years. In addition to the fact that these Class A renters are also at the highest risk of moving out to single family home purchase. And if we've seen anything in the recession thus far, it's that the single family market hasn't cooled down at all. It's still red hot. Exceptionally low interest rates. I just bought a home back in March of this year, and I'm looking at my interest rate now, and it almost makes sense for me to refinance because interest rates have almost dropped a full % from what I got back in early March. So the single family market is still holding on really well. That's siphoning off, at least in my view, some demand from Class A apartments. Now, that doesn't mean that that's going to be the end of all Class A apartment demand. I do think we're just in a little bit of a reset period, if you will. But again, looking at the different sectors of apartment market performance, I should say, you can see that Class A is a little bit underperforming. We're also seeing that in terms of rent growth. So this is looking at year over year change in effective asking rent. In other words, what's that sticker price for when a resident is shopping and moving into an apartment? How much different is their rent versus the resident they're replacing before them? And you can see that Class A is a little bit underperforming these other product types. Something that's been a little bit interesting over the past month or two is that Class C rent growth has dipped negative. It's barely negative, but we were seeing Class C apartment demand hold on relatively well, especially in some of these Sun Belt markets where the $600 additional stimulus money per month was just going a lot further than it was in, say, New York or Washington or California. But nevertheless, again, if somebody would have told you that we were going to hit the kind of recession that we did, I think a lot of people are pretty pleased with rent growth of about, let's call it -1% over the past 6 to 8 months, considering that economic backdrop. Now, any questions thus far before we switch over to some? And I do have some more national stats here, but I don't want to bulldoze the conversation. So any questions thus far?
Yeah, I have a quick question.
If
I was
not,
just you
go ahead.
mentioned
Sure.
you mentioned the Class A apartments were hitting kind of a reset. Do you have any guideline of how long that reset's going to be, a time frame, or maybe that's a premature question, but
No, I'm glad you asked. It's a really good question too. I would say that a lot of that's going to be dependent upon the market. If you look at some of these markets in Florida in particular, where I'm going to pick on Tampa, where it's been a consistent over the past 5 or 6 years, lots of supply coming on. That's going to be different than a market like Palm Bay, where you've got a huge run up in supply over the next year. Overall, if I just had to paint with a really broad brush, I would say that the next, let's call it 12 to 24 months, I think that Class A, I do think Class A rent growth returns positive before then, but I think the next 12 to 24 months, you're going to have some challenges with product working through lease up. You're going to have some areas that are maybe a little bit softer, but overall, if I had to, again, paint with a broad brush, I'd say that Class A fundamentals are stabilized within the next 12 months and then improving within 18 to 24 months.
nice. Thank you.
Of course. Any other questions? If not, okay. Well, if any questions do come up, please do let me know. What I wanted to show before, again, I kind of paused there for looking at some different stats. This is looking at some of our, what RealPage calls our lease transaction information. In other words, this is coming from actual rent rolls. And again, something that really shocked us coming into the COVID-driven recession is that the number of new leases being signed over the past few months is pretty stable with where it was last year. So this is simply looking at the year-over-year change in the number of leases being signed. Obviously, in March and April, there was a huge dip as leasing offices were closed, and just everybody's trying to get a grasp of what's going on with the economy, what's happening with shelter-in-place orders, quarantine measures, you name it. Obviously, there was a huge dip in demand back here, but really since, let's call it Memorial Day, most of the markets across the nation have seen at least stable, if not improving, number of new leases on a year-over-year basis. And I wouldn't put too much emphasis on this noise right here. This is just because that was this data is looking at a rolling 7-day same store number. And this right here is including Labor Day. So obviously there's a little bit of noise there, but overall that trend just shows you that you've got more residents signing leases today than you did a year ago. Now, this isn't always a good thing, and that might sound counterintuitive, but when you look at some markets that are exceptionally hard hit, such as San Francisco, New York, I think you could even throw Orlando into that bucket. Some of those new leases being signed are actually because you're seeing 1 to 2 months free of rent being offered, and those concessions are actually incentivizing residents from, apartment 101 across the street moving into Main at First Street. That's simply just a transitioning of renters, if you will. And I think that's where that occupancy number is coming in. In addition, you do have some move outs to single family, particularly in that Class A space. But nevertheless, when you look at that overall number, this is encouraging and tells me that there isn't a huge disconnect between what's going on with the economic recovery versus what's happening on the new lease side of the market. And then what I wanted to focus a little bit of time on here, and there's a lot going on in this graphic, but what I wanted to focus on really quickly is this interesting disconnect that gets spouted out in the media where, you see that, the New York Times or the Wall Street Journal will say that, landlords rather, in New York are facing exceptional challenges. San Francisco rents are being cut 20-30% year over year. Particularly focused on these urban core areas. You hear a lot of the urban flat out to suburban submarkets. But what's fascinating to me is when you look at this year over year change in revenue growth, in other words, what's that bottom line revenue number actually showing you, that discounting for the urban cores, you can see that most submarkets in the nation are doing pretty well. This is 63%, 22%. What is that? About 80% of the nation's existing stock through September was still achieving flat to slightly positive revenue growth. So this is one of these slides that we've shown a time or two to kind of dispel the myth that, apartment market performance is suffering when you see that story that, Manhattan occupancy is at 80% and people are moving out of San Francisco in droves. Not to say that that's not true in some of those instances, but by and large, most areas of the country are still seeing okay to relatively decent performance, at least on a year-over-year change in revenue per available square foot. So this to me is a solid sign for the apartment market. It tells me that things are probably in better shape than what some of the media might be showing and covering. Now, that's the national overview. Any questions before we dip into some of the Florida markets in particular?
Carl, can you talk a little bit about, if you can, about this new package that's come out from, or at least will be coming out shortly, and whether that was factored into some of the analysis, or whether that still needs to kind of play out a little bit more before we can really do anything with that. But it seems like it's going to be a nice boost to a lot of folks that need it.
Yeah, and I'm glad you asked. It's difficult to say for sure, just simply because the announcement of that was so recent and it was kind of caught in limbo of congressional red tape. We thought that there was going to be some stimulus package passed. We just didn't know what that looked like. And I will say that we're actually, as a matter of fact, today just kicked off our round of 2021 forecasts through, I guess it'll be the end of 2026 at that point. So we're just now updating our forecasts. I don't know yet, without looking at the models, what they're going to say. I don't see how a stimulus package hurts apartment owners and operators. I mean, it just seems like it's going to be a much needed lift on the much needed lift to some operators and owners, but it's hard to say for sure what that overall impact is going to be. I do think if it helps any part of the market the most, it's going to be for your what we consider Class C apartments, so your most affordable product sector. I see that benefiting the most, but on top of that, you've also seen some markets, and again, particularly those in the Sun Belt, we're starting to see some of the tourism economy. It's a long way from fully recovered, but you're starting to see some reopenings. You're starting to see some level of returning to normalcy. So in those instances, it could be sort of a double positive because you do have some improving economic tailwinds boosting some of these markets in addition to the stimulus package.
Thank you. That was great.
Absolutely. All right. Well, if any other questions come up, please do let me know. I thought we'd move forward here looking at some of the Florida markets in particular. And probably not surprisingly, it depends on what economic sector you're looking at and even what market you're looking at. And the numbers are going to look quite a bit different. I thought this map does a really good job, though, of representing just the difference in recovery across Florida. And again, it's fascinating that overall, the markets that are probably getting the most media coverage are, of course, Orlando, and then looking at South Florida, West Palm Beach, Fort Lauderdale, Miami. That's the part of Florida that's seeing the weakest economic recovery, if you will. When you look at some of the other markets, particularly those that maybe aren't quite as tourism driven, not to say that they're not tourism driven at all, but a little bit less tourism driven, you'll see a much better economic recovery taking shape. So this is stacking some of the major Florida markets overall. I put in bold here some of the central Florida markets, and overall, again, outside of Miami, West Palm Beach, Fort Lauderdale, and Orlando, most of the Florida markets are recovering at a pace that's faster than the nation overall. And, you know, when you look at the California markets, this would look a lot different. If you looked at New York, it would look a lot different. But generally speaking, outside of a few of these weak or trouble spots, the overall economic recovery in Florida is looking a little bit better than what we're seeing in some other parts of the nation. Any questions on this slide? Because I think this is one of those, you know, potentially surprising data points to some folks. But any questions before we bump forward to the slide? Going once, going twice. Okay. Well, the next 6 or so slides here, and I'm sorry, I should have kicked things off by saying this. I'll send out an email to Ray after today's discussion. All these slides will be available. I'll have my contact information in here as well. So kind of consider that your virtual business card, if you will. So the next few slides are more of these summary slides. I won't spend as much time because I do dip into some of the market specific fundamentals here shortly, but this is simply looking at year-over-year rent change among some of these markets. And again, probably surprising to a lot of people on today's discussion, most of the Florida markets are still seeing positive rent growth. Now, it doesn't mean that things are as strong as they were a year ago, certainly not as strong as they were 2 or 3 years ago. But the fact that you've got huge job losses in some of these markets and still seeing some level of positive rent change is just really a testament to the fundamentals that are boosting overall apartment market performance in not only Florida. You know, obviously this is a Florida-centric discussion, but you could say this for a lot of the Sun Belt markets in particular. And I know some of the newcomers on today's call have asked about the Texas markets or expressed some interest in the Texas markets. And honestly, outside of maybe Austin and maybe Houston to some degree, the Texas markets would look pretty similar. You're not seeing phenomenal rent growth, but you're not seeing huge rent cuts either. The markets here, excuse me, the markets here that you are seeing some rent cuts in Sarasota and Orlando in particular. Orlando, I think that's a combination. You just kind of got a double whammy of a huge reliance on the tourism economy paired with an unfortunate wave of new supply coming online. Sarasota, this is one of these markets that even 2 or 3 years ago, we had written as we lack the demand side, but we were concerned about new supply because we had already identified a huge construction wave coming online. And I'll show some of these stats for these markets later, but I don't think we're necessarily surprised that we're seeing softness in the Sarasota market. Doesn't mean that that's always going to be the case, but right now, again, you just got that economic recovery paired with a pretty big run up in new construction. Putting together the stats for today's discussion, this was probably the most surprising data point that I looked at. But outside of, again, Orlando, Sarasota, we could probably throw Palm Bay in there. But outside of those markets, generally speaking, you're seeing fairly steady occupancy. And the fact that, you know, a Deltona and a Tampa, sure, occupancy has come down, but guess what? It's still close to 96%. I mean, that's just incredible. Orlando and Sarasota are, again, just those 2 weak spots for the time being that you just have that unfortunate marriage of new supply paired with some economic softness. Really nothing here that's going to be, you know, super critical to the discussion, but I did think it was a good way of looking at some proxy indicators of market health. Generally speaking, markets with higher concessions are going to be the markets that you see more weakness in. But generally speaking, looking at these concession values, this isn't anything terribly out of line with what you had seen, you know, even heading into the let's say the 2014, 2015 period. And these concession values are certainly a lot less than they would have been heading into the 2008, 2009 recession, where most of these markets were not only dealing with huge economic cuts, but you had a huge run up in single family completions as well. Outside of, again, of a few trouble spots, you don't have that single family market putting as much pressure on multifamily fundamentals today as you did 10, 15 years ago, at least not from the construction perspective. Doesn't mean that there aren't some headwinds from the financing and from the mortgage rate side, but overall, you don't have a huge run up in construction activity that's challenging some of these fundamentals. Where you do have a run up, however, is in some of these markets looking at multifamily completions. And I think that's on the next slide. So I'll flip back to the demand side, but looking at annual supply as a percent of existing units in pretty much every market outside of perhaps Tampa, you've got a lot of units completing. Now in Lakeland, that doesn't necessarily have to be a ton to move the needle versus what's completing in Orlando and Tampa, but overall, some of these markets looking at 3, 4, 5% inventory growth. Another way of looking at that is for every apartment that exists today in Palm Bay, or every apartment that existed 1 year ago, I should say, in Palm Bay, there was, I'm sorry, for every 100 apartments that existed 1 year ago in Palm Bay, there's been 5 additional added over the past year. So that's another way of looking at this percentage growth number. But in some of these markets, again, a pretty big run up. Tampa is the one kind of exception to this, and I'll show a graph that looks at Tampa performance here in just a second. But Tampa hasn't necessarily been Tampa's not one of these markets that's had a huge run up so much as it's been a pretty consistent, I wouldn't go as far to say war of attrition because there has been enough demand there to support fundamentals, but developers keyed in on Tampa pretty early in this economic cycle, and it's just had a pretty steady wave of completions, particularly so in downtown Tampa. We're starting to see that ease a little bit, but I do think if there's one point of softness in Tampa, it is that urban core. I think it's just, I have to look at a map, but I believe it's just east of Channel View and then into the center part of the market. And then you could probably say for the same of central St. Petersburg is what we call that submarket. But I would say right in the heart of St. Pete, there's a little bit of softness due to new construction there. Now, any questions on that real broad overview before we look at some of the markets in particular?
Yeah, do you know which markets are having the least amount of supply? I mean, those were the most, but I'm just curious if you have any of that data.
So I do, and I've just stacked together the major Florida markets here. This is looking at, here we go. So this is the total supply. I would say that most of the markets that aren't seeing much supply are going to be those that are in the Sun Belt, but not your tier one markets. And I don't typically like using the term tier one because it makes you think that, there is an opportunity in Memphis when there clearly is. But when you look at markets that are kind of secondary to those major economies in the Sun Belt, think Memphis, Greensboro, Virginia Beach. You could probably throw in, with some other good examples here, probably throw in Fort Worth to that. I would say those are the markets that aren't seeing as much supply. And some of this information, I'd be more than happy to send some specific data later as well. But again, it's not that, I really hate using the term tier one and tier two, but I would say it's those tier two Sunbelt markets that aren't seeing as much supply over the past year, and probably aren't going to see as much over the next year until, permitting volumes actually start to change, if they do at all, which they may not.
Interesting. How about in Florida? Any spots in Florida with a low supply that are still kind of up and coming?
Some of the low supply markets are going to be those, and I'll flip back here. If you look at the map, some of the low supply markets are up here in the northern part of the state. It's been really interesting over the past 5 years or so. We've seen a lot of construction here in the South region. We've seen a lot of construction over the past year in Cape Coral, Fort Myers, Sarasota, but we haven't seen as much in these northern Florida markets. Jacksonville's been surprising. There hasn't been a real big run up in completions over the past few years. Tallahassee and Gainesville. Some of the more student-driven markets, I would say. Now, on the student housing side, we're seeing a lot of construction at Florida State, University of Florida, but generally speaking, the conventional side of the market, I would say anything north of Orlando has been pretty well insulated of new supply.
Great answer. Thank you.
Absolutely. And again, some of this information, if there's any questions that happen to be a little bit more data driven after the call, then I'll be happy to send along some information. I'll share my contact info on the main deck that we shared today. So looking at some of the individual markets within Florida, and I'll go through this fairly quickly. I don't want to overstay my welcome. I've got about 20 minutes here, it looks like. I'll go through each one of these Central Florida markets in a few minutes. But what we're showing here is on the left axis is going to correspond to the line that's in dark blue. That's looking at year-over-year rent change. The purple shaded area in the background corresponds to your right axis. That's going to be where rental rates sit in these markets. And I've split this for about 5 years preceding current, and then 5 years forthcoming. In other words, what's our forecast say? So in Palm Bay, you can see that there was a pretty big drop in rent growth from 2019. A little bit of noise in the data, just a small market. So obviously there's going to be a little bit of volatility, but up until 2019, fundamentals were pretty good. It's not surprising that in about first quarter 2019 up and through the first part of 2020 corresponds with a huge run up in completions here, where you had about 7% inventory growth, or about 2,500 units completing on an annual basis over the course of 2020. So that rent growth line that's not coincidental that weakening rent growth corresponds with a big run up in completions. The more important question is, what do we expect going forward? I do think that Palm Bay is going to be soft for at least another few quarters as this big run up in supply is worked through absorption, as that gets leased up. But moving forward, Palm Bay's economy, I think, is in pretty good position, or the Space Coast, even, I guess that would be another name we could use for Palm Bay here. But overall, I do think the economy of Palm Bay is a little bit better positioned over the next few quarters than, say, in Orlando or a Sarasota that's maybe a little bit more reliant on the tourism economy. And something interesting is, this is looking at the way the Bureau of Labor Statistics breaks out the data, but you'll see that manufacturing makes up about 12% of the economy. this number on the interior here is looking at a location quotient. In other words, what percent of the local jobs in Palm Bay, what percent of the economy is that relative to what the national average for manufacturing is? So in other words, it's 1.5 times more likely to find a manufacturing job in Palm Bay than it is in the nation. And a lot of the manufacturing jobs here are going to be more driven by, again, NASA, Cape Canaveral, some of those employers rather than your traditional Rust Belt manufacturing, if you will. So I do think that Palm Bay's economy is in pretty good shape over the coming few years. And I think that'll help boost some apartment market fundamentals. Looking at strengths and weaknesses, that economic makeup, you've got pretty good population growth over the past few years. You've got good solid population growth in that 20 to 34 or 25 to 34-year-old age group. Doesn't mean that there aren't weaknesses. You're going to have the single family market in competition. This is an older population. In fact, the median age is about 48. So you're going to have a lot of single family demand. Doesn't mean you don't have any multifamily demand, but that does serve as a little bit of a headwind. And of course, going back to that new construction, this is a big number. It's going to take a few quarters for that to get absorbed before what we at least are forecasting is a pullback in new supply into a more quote unquote normal level of construction activity. Now, any questions on Palm Bay before we look at some of the other Central Florida markets? And I hope this makes sense how I've laid this out. Each one of these Central Florida markets that we're covering will have each of these 3 slides. So if we move to Lakeland, the first thing I wanted to show is, again, looking at that rent growth and supply chart. The overall volume of units completing in Lakeland isn't nearly as big as either Tampa or Orlando, but because it is that center point and it's just a smaller market, again, it doesn't take as much construction activity to move the needle, if you will. And you can see that over the next year or so, we've got some softness in the market where not only is the economy obviously weak, but a pullback in rent growth. It's not surprising that that coincides pretty well with rent growth levels back here, where you can see that there was a slight pullback before you had the construction activity. Now, some of this was concessions burning off that led to a little bit better rent growth, but nevertheless, I do think that that completion activity in Lakeland is going to be enough to soften fundamentals for the next few quarters, but the market does recover pretty well, achieving, let's call it 3 to 4% rent growth in 2022, 2023, and 2024. Now, I think if there is one concern I would have in Lakeland, it's that because it is the center point between Tampa and Orlando, it's probably never going to have that really solid economic makeup. If I were to use the old saying, always the bridesmaid, never the bride, I think Lakeland kind of fits that profile where, again, that economic makeup doesn't look quite as good as what you have in Tampa and Orlando. Lots of trade, transportation, and utilities jobs. That would be your retail jobs, your warehousing jobs, just not your job growth that you're going to see being achieved in Tampa nor Orlando. And a lot of that will be reflected in the strengths and weaknesses here. So any questions on the Lakeland market before we move forward a bit?
There is there's a rail development, a rail depot that's kind of south of kind of southeast, I guess, of Lakeland, and kind of just almost straight south of Orlando. That obviously is where you have your deep water ports that are kind of rolling in the rail into there. So do you see anything, as far as creating some growth in between there because of that kind of logistics hub?
Yeah, absolutely. I think that'll definitely benefit economic growth in Lakeland. And I hesitate to say that I was showing this economic makeup slide here. I don't think this is a bad economy by any means. It's just, it looks different than either Tampa or Orlando. And from one perspective, I think you can make the argument that a lot of these trade, transport, and utility jobs this is a good tailwind, if you will, for those bread and butter Class B apartment rentals. I think the luxury product space in Lakeland rather is going to be a little bit softer because you don't necessarily have these big corporations that are fueling that typical Class A demand. But when you look at that bread and butter Class B or Class C apartment demand, I think that, and to your point, Ray, looking at that rail, some of that logistics hub, that churns good demand for Class B apartments. So I think that's a really solid opportunity in Lakeland in particular.
Thank you. That's good.
Absolutely. All right. So looking over at Tampa here, let's just move a little bit east, or a little bit west rather, and look at the Tampa market. Honestly, something that's really surprised me is that I didn't necessarily think Tampa would be a national underperforming market through the COVID recession. But what's been fascinating to me is that rent growth still hasn't dipped negative despite COVID-19. This has been one of the most resilient markets in the nation. And I used that example earlier where Tampa never really had that big run up in new supply. It's just been a constant way, it's pretty steady, about 5,000 to 6,000 units completing on an annual basis. Really for the past 4 or 5 years, we can see that continuing for the next at least 2 to 3 years. But nevertheless, Tampa's had pretty decent demand, and we still haven't seen rent growth dip into negative territory. As a result, you can see our forecast calls for good, not necessarily great, but good, solid rent growth over the next 3 to 4 years as well, just because the market hasn't really ever had to hit the reset button, hasn't ever had to pause, and we're seeing just overall solid fundamentals. I think part of what's driving that is the fact that the Tampa economy is made up of some pretty attractive economic sectors. Professional and business services is largely, again, those office type jobs, your typical white collar jobs that aren't necessarily finance related. But even when you look at finance jobs, Tampa's about 1.5 times more likely to have a financial job than the national average. And that churns really good Class A apartment demand. I also think something else helping out Tampa, and I don't have the data embedded in here explicitly, but looking at Tampa's median age of renter, it's the highest in the nation. And to me, that points to a lot of retirees that rent apartments in this market. And those renters aren't going to be affected by an economic downturn. They've already got a fixed income. They've already got a steady stream of money coming in. So a recession just doesn't impact Tampa to the degree that you see in Lakeland or specifically Orlando. And because of that, it's just one of these higher floor markets. May not ever be your market that's your home run market, so to speak, but it's also not that market that's got the lower floor. Tampa's a good example for any baseball fans on the call today. I call Tampa one of these markets. It's kind of your leadoff hitter. It's probably never going to hit you that home run, but it's probably not going to strike out either. And that might not be somewhere that's going to be attracting all your investment activity or all your investment interests, but because of that low floor, low ceiling, that can be an attractive diversifier, if you will. So looking at some of the strengths and weaknesses here, again, one of the few markets that hasn't seen rent cuts just yet. One concern I would have on Tampa in particular, though, is that population growth has slowed down over the past 2 to 3 years. Still phenomenal population growth. Don't get me wrong there. Still much, much, much faster than the national average, but you're just not seeing quite the same population growth as some other Florida markets. And it's a little perplexing to me, to be honest, because you do have pretty good economic growth. You have a lot of retirees moving into the market. So I'm wondering if Tampa just isn't getting quite the same influx of international in-migration as in comparison to Orlando and Miami and Fort Lauderdale. But nevertheless, again, I think this is a market that's just a high floor, lower ceiling market, and there's nothing wrong with that. All right, so switching over now to the kind of one of these markets that I guess it depends on who you're asking, if it's Central Florida or maybe kind of on the edge of maybe getting into North Florida, looking at Deltona, Daytona Beach. Really, I think the theme in this market over the next year or so is just going to be how the market absorbs this massive run up in completions. And I have to be honest, I haven't ever been to Deltona or Daytona myself, but I imagine if you were to drive the coast, you would probably see a lot of construction or a lot of deliveries coming online over the next year, where you've got about 2,500 units completing annually in first quarter 2020. That's a big number. Not surprising as a result, you can see that rent growth has really softened, and we're calling for soft rent growth over the next 2 to 3 quarters before stabilizing in 2022 and 2023. Now that is interesting, because this can also be a market that's a good time to buy. You know, I hesitate to say that, you know, this is what you should or shouldn't do. I should have a disclaimer in here to say that I'm not giving explicit investment advice, but, you know, obviously you want to buy at the bottom and sell at the top. This could be one of those markets that might offer you that opportunity, just because that is a big completion volume coming online over the next year or so. When you look at the Deltona economy, again, it's nothing for me that, you know, with leisure and hospitality making up about 15% of the economy, you're about 1.7 times more likely to find a leisure and hospitality job here than you are nationally. That's not necessarily supportive of strong Class A fundamentals, especially when you've got a huge run up in completions occurring. So I think if there is some opportunity in Deltona, Daytona, it's probably for that, let's call it B to B plus market, maybe something that was completed previous to the Great Recession that isn't quite complete, or no, I'm sorry, not completing, isn't competing with your ultra luxury Class A apartment, but you know, you just got that steady bread and butter apartment demand. I think that Class B product space in Deltona offers some opportunity relative to some of the other markets that we've discussed thus far. Now, again, similar to Tampa, an aging population growth is slowing down a little bit. That economy isn't necessarily your Class A renter driven economy, so to speak. But again, that doesn't mean that there's not opportunity in that market. All right, so the last one I wanted to cover here before turning it over for any questions, look like I got about 5 minutes left. Looking at Orlando, which is just, again, being candid, is probably one of our bottom 5 markets over the past few months due to the coronavirus or COVID-driven recession, I should say. And it's not necessarily just the fact that you've got a huge cut or a huge pullback in tourism jobs, but you've just had a huge and steady and consistent wave of completions in Orlando, particularly in central Orlando, or at least what we consider central Orlando. So if you look at the part of the market that has a lot of convention centers and where a lot of that business growth is happening, that's also the part of the market that's seeing the most completions occurring. And when you look at the recovery in Orlando, again, we're forecasting, let's call it 2 to 2.5% rent growth over the next few years. It's not so much the family tourism that I'm concerned about in Orlando. I think that the Disney World type of tourism and those jobs do recover. My biggest concern would be what happens with corporate spending and what happens with conventions over the next 3 to 4 years. Do you ever see conventions and these big company settings come back to the same level as what we saw back in, let's call it pre-2020? Families, you know, there's always going to be demand for that. You're always going to have international inflow into the Orlando market because it does have such that presence of tourism, but the convention market, it's enough to concern me. Now, that doesn't mean that there's not opportunity in Orlando, because I do think that there's plenty of opportunity in the market. And the market has done a really good job of diversifying when you compare, let's say, 2020's Orlando economy versus 1990 Orlando or 2005 Orlando. The market has done a good job of diversifying, but I think you just have to be a little bit more cognizant or a little bit more aware of what's going on with today's Orlando economic makeup versus 1 year ago. Now, there's tons of strength in the market still, particularly that population growth, something that's been interesting over the past few years is we've seen that a lot of the international immigration that would have typically been going to Miami, Fort Lauderdale, West Palm Beach, a lot of that's now moving to Orlando simply because it's more affordable. You know, it's so expensive for a family to move into Miami or West Palm Beach or Fort Lauderdale. But if you move to Orlando, it's a few $100s a month savings to live in something that's probably even a little bit nicer than what you would have in Miami. So I do think that gives some opportunity again for that Class C and Class B space, but I would be a little bit wary of Class A fundamentals in Orlando, at least for the next year, but I would even go as far to say the next 2 to 3 years. That's going to be a market that we're going to keep a close eye on. So having said all that, I know that's a ton to go through in a short period of time. Any questions before I turn it back over to Ray to wrap things up here? And I'll pull up I see some things came in through the chat here. I'll keep an eye and see if any questions came through, or if it was just, looks like it was just people sharing information. Thank you for doing so. But with that said, Ray, I'll turn it back to you. Any questions from the audience?
I know not necessarily a question, but I'm glad you addressed the, potential opportunities, because I think, when you start looking at these markets, you got to look at them with the prism, if you will, that, you're trying to capture these markets when they're not necessarily in their prime, because, that's not where the opportunity is, right? The opportunity is in a market that is starting to, it's finishing off, it's starting its expansion phase, frankly, and when you look at these things. So it's always good to pay attention to the longer term trends when you're really starting to target or wanting to target a market. And so I'm glad you mentioned, for example, a place like Deltona and other places where there may be some opportunities to really get after, because once everybody knows that something's hot, there goes your supply, right? Because everyone's going to pop in there and just going to ruin it for the rest of the investors trying to make these things work, and they run up the price. So I'm glad you mentioned that. I think that's important.
And especially too in apartments, because this isn't, a 1 year flip, or, if it was single family, you might be looking at a real short hold, but, you're putting a lot of money into these apartments. So you're probably going to hold it, maybe not a full developer hold where you do it for 5, 7, 10 years. But, like you said, this is one of those times. And interestingly enough, and I apologize, I didn't have any capital markets information here, but the multifamily investment space, I mean, it's barely even hiccuped despite the recession. You've seen a lot of weakness in office space. Of course, retail, this is looking like a little bit of a bloodbath in some regards for retail performance, but industrial multifamily, I think that we're entering a new paradigm where the next let's call it the next decade or so, you've got really good tailwinds for those two product types in particular. So I think it'll be interesting to keep an eye on. And, again, to your point, Ray, this makes at least the argument for a potentially attractive time to buy into the multifamily space.
Excellent. Any other questions from anyone before we move on? All right. Well, Carl, that was fantastic, man. I need to go back in there and take a look at these in a little bit more detail for sure. And I'll definitely make that available to everyone. I'll make sure we can pass that. I know a lot of folks couldn't make it today. It is Christmas, week, and so
right.
Kudos to those of us who are here, but people people have family considerations, etc. So I got no qualms, and hopefully we'll get some good traffic on YouTube for this, because it is some very good information. Usually you get these things and you get very national type trends, and you never kind of dip down into the markets where you're trying to do your investing in. So this was good to bring it down to that next level. So I think what we'll do now is just at this point, I want to open up the floor to anybody who has something they want to highlight, whether it's a success that they've had in their acquisitions, whatever it is that you're kind of focused on. If there's something that you want to bring up, this will be a good time. And so I'll open up the floor. Come on, somebody.
I think Brendan's on mute. He doesn't realize.
Oh, I didn't see him. Let me see. see if that unmuted him. Can you hear us, Brendan? No, can't hear you yet.
And I'm terrible at reading lips, so.
Yeah, I don't know. It doesn't look like he's, yeah, it looks like he should be good. Maybe there's something going on over there on the system. Now it looks like, there you are. Can you talk now? No, you lost the audio. All right, we'll have to put it on the chat or something so you can get that out. So hopefully it's good. And I guess keep trying. Who else? Anybody else? All right. Well, I guess I'll add one thing. Some of you probably have seen that you know, some of the activities that I got. We just closed on a 19-unit townhouse development, and so this is in Nashville suburbs, and so it kind of has the same, you know, sort of feel with a lot of what we're talking about here, where some of the main metros are maybe not doing as well as some of these suburban markets as people kind of look to move out there. And we look to capitalize on that when we knew that it was going to be tough to do value add when you couldn't get construction crews to go into apartments that were occupied. And so we were able to kind of take that opportunity there and do a little bit of a different model, which is the build to rent model, which here, surprisingly in Florida, there's a lot of that activity going on. People buying, you know, land to buy single family to rent, and you know, and also to obviously some sales there. But I think that continues to be something that's happening, and so I was excited to get that done. We're still working on other deals. Brendan, you back on yet?
I have a question for Carl. Carl, can you hear me?
I can. Sorry, I just realized I was on mute too.
I'm wondering, from your perspective, as far as raising capital, what would be the number one, like, best thing to tell potential investors when they ask you about, like, the uncertainty of the market? Like, we also saw these charts. That's not necessarily something we're going to be able to bring to investors every time, potential investors. Like, what would be the one most important thing that we can say that will make a difference?
That's a good question. And if you don't mind me asking, you may have it over here in the chat, but what type of investment are you looking at? Because my answer would depend on whether you're looking for that class A or, you know, that B and C. So any insight there?
Right, B and C value add multifamily.
Okay, perfect. Thank you. I would say that something that's interesting to me is that you'll notice that a lot of construction, and particularly the Sun Belt markets, has gone into one of two areas over the past decade. It's either been downtown, so I'm going to pick on Orlando again, downtown Orlando, or it's been in some of the outer lying suburbs where you've got some suburban office there. It's been interesting that these interior suburbs over the past decade or so have kind of been an afterthought from a construction perspective, but that's where a lot of people live and that's where a lot of demand is. So I think there's a ton of opportunity there. There's still some meat on the bone for those infill suburbs for the value add space. Now, more globally speaking, I know that's a little bit more nuanced to, you know, your strategy there, but I would say more globally speaking is just looking at the investment that's gone into multifamily lately. Again, you've seen a big pullback in retail and office, huge questions there about what those look like post-COVID, but industrial and multifamily, the tailwinds look there. Also, I would say just looking at some of the single family challenges, particularly in some of these Sunbelt markets where you've just got to go so far out to be finding affordable housing. And I'll use my example, or my situation as an example where our office is about 25 minutes north of downtown. I live about 25 minutes north of that. So you know, it's just one of those examples where from the single family side, as far as siphoning off that demand, you know, that demand's got to go somewhere. You got to have somewhere to live. And I think that multifamily has a lot of really attractive qualities to it relative to single family, and especially relative to some retail and office investments.
Got it. Thank you.
Carl, I got so Brendan put something out there as far as this question on the chat. He's wondering if you can give some information on East Coast markets between West Palm and Deltona, like Stewart, Port St. Lucie, Fort Pierce.
Perfect. Yeah, no, I see that pulled up over here. So unfortunately, I'd have to my focus and my lens is typically on the south. What would that be? Southeast Florida market. So I'll have to do some research and get back to you. I'll send some information if you'd like me to. I do a little bit of prep work for the Central Florida markets, but my Southeast Florida knowledge is pretty limited, so I hesitate to offer anything. And it's what's the old saying? It's better to be silent and thought a fool than speak up and prove everyone right. So I'm going to hold my silence for now.
All right. Well, I'll hold you to that, Carl, to get us some info on that.
Yeah, but I will follow up with you, Brendan. So thank you for your contact info. I'll be sure to send that along.
That's good. No, I'd love to hear about that too. I actually have some assets out in Port St. Lucie. It's always good to get more info there. So good. Yeah. I know it is a little bit south. It's kind of weird. Treasure Coast doesn't really fall into South Florida, but it's not really Central Florida either. It's kind of in between.
Right. Kind of that same thing with the Southwest coast, where, you know, Naples and Fort Myers isn't necessarily that South Florida per se, a la Miami, but it's also not very Central Florida. So it's, yeah, kind of that weird geography there. So, but I'll be sure to follow up with both y'all.
Okay, so Carl, thanks again for the time. I know we're going to get quite a few people looking at this, just based on some of the feedback as far as folks not being able to make it to the meeting but wanting to get the video. So we'll get that out there. Like I said, I'll trim out some of the early and the end as we get into some of the the personal stuff, so I don't put that out there for YouTube anyway. And I really do appreciate you taking the time, man.
Of course. Well, thanks everybody.